And on today's show, why Index Universal Life works best in third-party funding. Part 2 of this week's series on self-funding Index Universal Life for income with premium funding strategist and attorney Robert Strauss. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to InsMark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to the show, Robert.
Thank you, Steve.
Well, we had a great introduction yesterday, and this is a whole self-funding. We're using corporate dollars, maybe corporate, borrowing from my employer.
Sure.
Intra-family borrowing, maybe my rich aunt or whoever. And then I'm borrowing kind of from myself, a kind of an asset redistribution. There's a lot of ways to play on that, and a lot of people say, what do I need the bank for? I got money to sit on the side to pull this off. So there's a lot of ways to play this, and this is just giving you, arming you, another technology to be able to sell Index Universal Life, especially for income. Now let's walk through the basics here. We're always talking about max funding and IUL and Index Universal Life to the MEC guidelines. But I also I heard you many times say, well, it's not just that, Steve. We're also sometimes looking at cash value accumulated tests. So it's not just the MEC guidelines. We might be doing CAVT.
Absolutely. So we test these in every case.
Every case.
Every case.
I love that.
Yep.
All right, and then the premiums are funded privately, whether it's through your corporation, whether it's through some relative in your family, and of course your own assets. And 100% of the interest or opportunity costs for 10 years. That's what we're really talking about. This is the thrill, really. And then reimbursement of sources within the fixed rate participating loan. Now, walk me through that in the best, let's pretend our advisors don't even know what that means. Walk me through the mechanics of that.
Okay, so what we're always going to be doing here is asking the client to pay interest out of pocket. And interestingly enough, we actually pay the interest at the beginning of the year, not the end of the year. Very much the same way we do with our premium financing program. But we structure interest payments up front and we mix principal in with interest. So we have this kind of levelized loan payment schedule that's payable at the beginning of each year, and at the end of the 10th year, we're going to pay back or reimburse the funding source the entire amount of principal.
And then the contract is sustainable from that point going forward.
And the contract's sustainable at that point going forward because the participating policy loan with the arbitrage creates so little friction on the contract.
So when we're ready to repay whoever, the corporate or family or my own reimbursements of my own asset base, I'm going to be taking out a tax-free loan, and that loan's going to repay whoever.
Correct. So there's going to be this tax-free loan that's going to create the reimbursement.
Now, when you were explaining this at first, people say, well, I'm already into the IUL market. Is this going to really take my practice from a traditional Index Universal Life, which everybody seems to be doing, and it doesn't really make me different than anybody else, to now I'm offering 3 different options here that are already configured in your patent pending methodology? I mean, that to me is the play here.
Yeah, I think it offers a whole new tool that many people have not seen before, and opens up whole new markets.
Generally, people do not come on my show and give their secret sauce away, but apparently you're going to do that now. So let's talk about the secret ingredient. Why does this work, and why is this Moody's corporate bond history slide such a big slide for us?
Well, again, the key here is to reimburse the funding source in a way that doesn't harm the policy. And most policy loans that are taken so early, especially a large policy loan taken in the 10th year, would cause so much friction on the policy that it would ultimately cause the policy to expire. Even a wash loan would ultimately cause the policy to expire after just a few years. So what we really have to do is create that arbitrage. And so the secret ingredient is a low interest, fixed rate participating policy loan. Now, if you look at 1,000 participating policy loans in the market, probably 995 of them are variable rate loans that are linked to the Moody's corporate bond yield. But if you're trying to create arbitrage, and that crediting rate has to exceed the policy loan interest rate, and the policy loan interest rate is moving up and down with the Moody's corporate bond yield, how do you know if you're ever going to create arbitrage? You need something that's fixed for the life of the contract.
Your thinking on a timeline is you have 2 of those areas where you conquered. You put a 10-year certain, and now we're talking about a contractually, by the way, fixed rate. That's what we're looking for in an IUL.
Correct.
Those 2 issues take away some of the uncertainty and give us a better probability.
And if you're borrowing money for the first 10 years based on the long-term AFR rate, which is also fixed, you've removed that uncertainty too.
So really, when we're thinking about it, whether it's LIBOR or the AFR rate, those are pretty low. We already know what those are.
And they're fixed.
We're looking at a standard blended annual point-to-point index. This is pretty straight up. You like this 100% participation or above. You like high caps or no caps.
Correct.
Talk a little bit about the thinking behind that.
Well, the idea here is this is an arbitrage play. So obviously we want a crediting rate that's going to exceed our policy loan interest rate of 5% or whatever the policy loan interest rate is on the given policy, typically around 5%. And the way you want to capture arbitrage is kind of similar to the way a crocodile eats. I call it crocodile arbitrage. A crocodile doesn't eat a lot of meals a day, or it eats an antelope and then doesn't eat for a while. Similarly, we want to capture arbitrage the same way. We want a big crediting rate, and then it doesn't matter if we hit our floor the next year. It's much more effective, and we don't mind the volatility of the market in that sense. Our floor protects us. Our floor of 0 or 1 or whatever the floor is protects us. And our high caps enable us to, when we hit our caps, capture much more arbitrage when we hit our caps than we lose when we hit our floor.
We come back from the break. We're going to show you your crocodile motif.
Okay.
And show you why this works so well right after the commercial. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, I'm with funding strategist and attorney Robert Strauss. Before we get into the actual crocodile arbitrage slide, I want to work you up to it a little bit with a little bit of methodology behind it.
Okay.
Here's your historical probability of 6.9, and you laid it out on a standard 100% allocated weighted contract, a blended indexed annual point-to-point, and you're just showing here's a cap of 15% with a 100% participation rate. It gives the probability rate 5-year, 10-year, 15 years, and we're looking at 15 years. We reach about 88.9% of the time, we're going to hit that number, 6.9. That's what we're talking about.
Correct. And so it's possible to backcast in, any particular crediting rate. You can plug in whatever crediting rate you would like and figure out the probability. One of the nice things about eliminating one of the variables, i.e. the policy loan interest rate, by using a fixed policy loan interest rate, is that now you can actually calculate the probability of success of the program because you're really only left with the variable of the crediting rate.
Okay. And now I want you to walk me through this a little bit because there's some mechanics here that may make you choose a different index. Right? You're going to bring it, and I want you to pay close attention to this because you may be a devotee to the S&P 500, but after this, maybe not.
Well, and that's true, and not every index is the same, and it's very important to take a look at the different types of strategies that are out there and calculate the probabilities of success. And remember, we're looking for arbitrage, so our perspective is a little bit different. So here, what we have is an uncapped strategy, which uses a very different approach. It uses a daily allocation. They hedge, this particular insurance company hedges on a daily basis, and based on the volatility of the S&P, they decide how much you go into stocks and how much you go into bonds. So let's take a look at the next slide. And so using that uncapped strategy, you can see that if I plug in the same crediting rate of 6.9%, the probability of achieving that 6.9% over rolling 15-year periods goes up from 88.9% to 97%. So not all strategies are going to yield you the same probability. So the only point that I'm really trying to make here is not all strategies are the same. You really should shop around product to product, strategy to strategy, and decide which is best for this program.
Now that may be a whole workshop we're going to have to come back to do because I think that is worth exploring. Now we're at your patented crocodile arbitrage. I hope you copywrote that. That's probably going to be pretty good. Walk me through this timeline because I've seen you talk about this before. This to me might be worth the whole segment.
Well, it's important to realize that, and I think people forget, that it's impossible to predict exactly what the right crediting rate is to use when you illustrate any concept, let alone private SFI. Is 6.9% the right crediting rate? Is 6.5% the right crediting rate? Is 7.5% the right crediting rate? I would argue they're all the wrong crediting rate because when you plug any crediting rate into the software, it assumes that you're getting that crediting rate every single year forever. And as you can see here, these are historical numbers of the strategy I just showed you. You're never going to get the same crediting rate every single year. The equity markets are going to bounce around. So what you want to do is capture arbitrage with a strategy that has a high cap and a floor of at least 0.
Well, this chart, I have to say, honestly, Robert, this kind of startled me because I'm looking at a 25-year timeline back the last 25 years, and I only have 3 negative years because of the indice, this blended indice. Sometimes they're not all created equal. They don't yield equally. And now we're looking at a timeline that says, then this is incorporating the lost decades. So this blows my mind because we had 4 in there and it's not showing up.
Right.
So that is a startling revelation to me.
Well, yeah, that's a good point. And what else is startling to me is that even if you eliminate the 39% year, which is probably a big anomaly over there, and you just look at some of the other big years, 15%, 14%, 15%, 16%, 21%, and so forth, 24%, 16%. Every time you hit one of those big years, you're getting a positive spread of the difference between of maybe 10%, right? The difference between your policy loan interest rate and 15, your policy loan interest rate and 14, and so forth. You're making 10 points of spread. But every time you hit your floor, which is not very often, you're losing 5 points. The most you can lose is 5. But every time you hit these big crediting rate years, you're making double that. That's the way you want to capture arbitrage.
I think something, too, we're so enamored with the accumulation phase.
Yeah.
And the Crocodile arbitrage is really remarking on distributions. It's really targeting distributions. And when I'm looking at this timeline and I'm looking at the spread, if I went back and said, okay, 0 that year, 0 that year, 0 that year, and I ran, let's say I'm age 65 here, and I'm running it out to age 90, which would be your 25-year timeline, that's when this becomes dramatic.
It does.
Because now you're looking at numbers. And again, traditional S&P 500 does not look like this the last 25 years. That's why this blended, there's certain indice blends and tactics that really are superior.
And when you look at this and you actually look at the impact that these positive years have on cash value, these big years have a much more dramatic positive impact on cash value than those 0 years have in terms of a negative year on cash value. So it's very, very powerful.
So the numbers aren't equal.
They're not equal.
Yeah, there's some geometric or maybe even exponential on some of these numbers.
Correct.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you tomorrow.